Can you hear me? I think we've had a lot of tremendous food for thought this morning, and we have really the perfect session before the coffee break where we're going to have one of the top investment bankers and a couple of public owners kind of talking about their view on capital allocation and how to responsibly invest the money of their shareholders. So Tony Renzi was going to lead the show from Vedder Price. Come on down. Thank you. Yeah, thanks. That one's mine.
Okay, sounds good. Waters are good?
Yeah. How are you? Here you go. Are you bummed out? What? You're bummed out? I know. I love it. I love it. You're the dean of the CFO fraternity, so probably should defer to you.
Ted picked the walk-up music.
And I mean, I should have deferred to Jeff because he is sort of the dean of the industry, and probably just to make it clear,
that just means old.
Yeah, but he is known when he is captaining ships as El Jefe, and so I think it is only fitting to refer to Jeff as El Jefe going forward.
Thank you, Ted. Tony, welcome to a panel with Ted and Jeff. So, that's why they rotate the moderators every year, because we didn't even let you get a word in before you could start. So let's.
That's no problem. And I think everybody's here to listen to what you all have to say. So thanks for us. Oh, first, thanks very much to Mike and Matt and the Marine Money team for organizing this fantastic event. It's always a fun day, and we look forward to being a part of it. Our panel is capital allocation in a robust market, which is a fantastic topic, and we've got a great panel to take us through that and guide us through the jungle that is capital allocation. So let me do quick introductions. I'm sure you all know everybody anyway, but Ted Young, CFO and Treasurer of Dorian LPG. Jeff Pribor is Senior Vice President and CFO of International Seaways, and Jay Kwon is Managing Director at DNB Carnegie. I guess to get this started, capital allocation. So as we often hear at these events, the shipping industry does great in times of turmoil and chaos, and we've had plenty of that. I think for the last several years, most companies have been doing quite well and paying dividends and paying down debt. So, as you look forward here, as they say, the market's pretty robust right now, but there's clearly headwinds over the next year or two. You have tensions and trade and tariffs and geopolitical uncertainties and environment, regulatory environment that's more onerous by the day. So as you're looking at calibrating your allocation of capital, are you looking more at paying down debt, making investments in fleet expansion, decarbonization investments? What are the key things that you're looking at, and how are you dealing with the inherent trade-offs as you make these decisions, guys? We'll start with Ted and work our way down.
Well, the short answer to the question is yes, absolutely. Look, but that is a very true answer. We all have to balance. Well, not Jay; he gets paid either way. But we have to balance how we allocate capital. In our case, actually, in many shipping companies' cases, dividends are important. They underpin our valuations. They play a huge part in total shareholder return. Many executive teams are compensated on that, so there's a lot of alignment of interest. On the other hand, we CFOs know that maintaining a healthy balance sheet is important, and that's the right amount of debt and the right amount of cash. And what that is in the eye of the beholder. And as you alluded to, the regulatory environment is changing. As Nico Schus talked about, obviously there was some controversy depending on where you sit. And as a firm, we don't take a view. We take the view quite simply that we have continued to decarbonize because it's been good for our business. We are consuming less fuel and have lower emissions. And since both fuel and now emissions cost money, this is good for our shareholders. We will continue to invest. It's not going to change. These are particularly high return investments, and so we'll continue to look at ways to invest because we think it benefits our shareholders over time. And I would say the arc of history in this regard is rather inexorable, and so we're going to end up all having to get to lower levels of emissions, whatever it may be, And so these investments make sense over the long run.
Yeah, I think this is. We started this morning with a history lesson from Dr. Adamu and from Mark, and so I'll keep going. When I think about the question how we as a public company invest in the capital that we have or that we generate, I'm reminded first of one of my favorite books is called The Outsiders, and the preface it's about people like Warren Buffett and stuff like that, sometimes being the best capital allocators. But the preface to it, the author talks about there's only three ways to invest cash flow in from a corporation that you generate. One is to reinvest in the assets that you have or other assets like decarbonization assets. It's to delever, or it's to return cash to shareholders. So only three ways. So this is it's a good story since Lois is here. It's a difference in a CFO and a CEO. I photocopied the preface to her and gave it to her one year. The next year she gave me the book. So that's what a CEO do. Here's the book, right? So anyway, so that's how we think about it. And now the history part of it is thinking to Mark's comments about IPOs. Well, I looked it up. Our predecessor company was OSG. It went public right around the year that Lois was born. So I'm not going to tell you when it was. But it's been a while. But you think about capital, not that long, Lois. Sorry, but it was before Mark's examples. But the point is, the way to answer your question is, here's how we think about it. However long ago it was, we started with some capital. It was probably a family that started it with their capital, and then if you've gone public, you augment it by widows and orphans or proverbial investors, whoever they are, even hedge funds, that's giving you some money. And you take that money and in shipping, you invest it in a ship. Steel, it doesn't matter if it's LPG or LNG or crude or product. And then that ship generates cash flow. And ultimately, you sell it, and that's further cash flow. So what do you do with it? Well, I just told you, there's only three things you can do with it. A snarky investment banker, not Mark, says that there's a fourth, which is to lose money. But let's say you're generating free cash flow, which we're doing a lot. There's only three things. And so the way, and Ted is so right to answer your question. Yes, it's not any one of them. I hate it when it's like, well, what's your strategy? Is it deleveraging or is it returning cash? No, all the above, right? So what we did in this upturn in tankers that started in 22 is you adjust a little bit. So we were heavier on deleveraging because we wanted to get to a lower leverage spot where we had more free cash flow, more optionality, what to do. And what we've done now, and I'll stop so Jay has a chance, but where we are now, last couple of years, is to be at a leverage point where we can look at that free cash flow and say, we're going to give enough back to shareholders. It's the dividend primarily, but we have a share repurchase option on top of that. But that's all the bucket of return to shareholders. Give enough that it's robust, it's competitive with our peers, it will attract capital, people to stay or to come into our company. But yet we'll retain enough to be the equity piece, because we'll use some leverage, but the equity piece for fleet renewal. Because we will renew our fleet throughout the cycle. Not talking about when you look back at the truck, as my old mentor, Jim Dowling, used to say, and put all the money into assets. That's probably, as you heard from Beth on earlier this morning, probably not right now. But through the cycle, even without worrying about inflation adjusting, we will have some of that free cash flow goes to renewing the fleet. And that's our philosophy.
All right, thanks. Jay, when you're advising these guys, what are you thinking about? What are you advising them to do?
Sure. I think Jeff made a good point. I think it's interesting because several years ago, most companies didn't have the luxury of actually thinking about what do we do with this excess cash flow. So this is a pretty unique time for us, especially when you've seen so many, really all sectors within shipping perform so well. And so the discussion's actually shifted. I think it's more, as Jeff said, about how do you make sure that you are utilizing the excess cash in a proper manner that is beneficial for the company overall, thinking about the long term, but at the same time trying to make sure that you balance the returns to shareholders as well. And so I think we've seen this trend where there have been, special dividends, let's say, or higher dividends paid, share repurchases. At the same time, I think you've got this conundrum, which is asset prices are high. And so do I really want to buy today versus waiting maybe a couple more years to see if things start to reset? And so I think that's part of the challenge, I think, and I don't envy Ted and Jeff here, but I think that's one of the things that I think as we think about companies, how do they best utilize that cash? And I think there are ways to do it in a prudent manner. Like Jeff said, you don't just go all black, right, and decide I'm going to go ahead and make a giant purchase, but maybe it's taking those steps to make secondhand purchases, new builds over time as well. I think what this does show is that there is clearly an opportunity for companies to try to take advantage of this very strong market. It wouldn't surprise me if we see one or two big deals that come, because as you have the ability to potentially use your share price and your shares as currency, I think there is opportunity to think about growing the business and thinking about, how do we take advantage of the current leverage profile we have today. So I think that's probably one of the next steps we're discussing, which is, liquidity is obviously very important. You want to make sure that you can make it through the cycles. But at the same time, we all know that in shipping, and particularly within the public markets, you need to be big. You can't be a small company. It's just really difficult to get investor appetite, investor interest, and frankly, investor following. And so I think there will be some pressure to continue to get bigger, especially as a public company. And I think that's where, as we talked about, potentially using shares as currency could be one way to do it.
I was just going to follow up. I think both Jay and El Jefe made a lot of good points about what we're talking about. And I think I'm going to crib off El Jefe's comment from about a year ago, which is we deleverage so we can re-leverage. And that's exactly right. And I think what underpins all of this, and Jay just mentioned it, and it's also a bit of a response to Nico's thoughts about public companies, we're in a very cyclical business. Our job as management teams is to raise capital generally cyclically and to invest counter-cyclically. That's really the trick. And so, you look at what El Jefe and Lois did this year with a bond that was brilliantly executed, best pricing, I think, maybe ever, certainly for a first-time issuer by far. And that's exactly what they should be doing. As they're in a different point in their cycle probably than we are in ours, but that's the beauty of public companies, because one, you can diversify, because even though Nico's absolutely correct, you own a ship and you operate it and all those things, not everybody wants to do that. So the ability to buy and sell, it's much easier to sell a share of a shipping company than it is to sell part of a ship. It's actually virtually impossible to sell a part of a ship. So, it's another overlay of the kind of complexity of capital allocation that we all face, but it's what makes shipping really interesting and a very exciting investment proposition, because great fortunes have been made in shipping.
Yeah, I mean, just to pick up on that a little bit then, Ted, how much liquidity is enough? I mean, one of the things I think that a lot of people are and Jay had mentioned it, you're in the great position of most companies having, significant cash flow. You're in a position where you can pay dividends, you can pay down debt. The Norwegian bond market is that, had a historic year last year. This year seems to be fantastic as well. It looks like the equity markets may even be opening. Okeanis just did a public equity raise of $115 million. So it seems like there's plenty of capital available through different means. And so how much liquidity is enough? What do you guys use as a metric for trying to determine when to go to the market, when not, and things like that?
Well, first of all, Ted opened the equity, and his colleagues opened the equity market for shipping last year. So that's the record show. So well done, Ted. And while we're talking about bonds, thanks, Jay. DNB was terrific. We had a couple other great advisors as well, but DNB was lead left and did a fantastic job in that bond. So we didn't do that for extra liquidity, by the way. We had a use of proceeds. So we actually paid down some legacy secured debt that was more expensive than the unsecured debt we raised this September. So really didn't, but we did end up with, where we are now after having done that pay down is about $700 million of liquidity. And that's the right way to look at it. It's not cash. It's cash and undrawn revolver, because that's your piggy bank, right? It's an undrawn revolver. But there's more. One of the things the bond did for us, along with our deleveraging over the last few years, is we have about $1.2 billion in unencumbered assets. That's a piggy bank. So, I'm going to agree with someone else who's not in the room right now, but there's never too much liquidity, right? I mean, there's some tactics around. Like, I'm not going to pay to have $2 billion in revolvers. I don't need that. But we've got this piggy bank. So, at the point of deleveraging is to relever. Like, Thanks, Ted. And we have over $1 billion of firepower when it's the time to use it, which is probably not right now, but we're ready.
Yeah, I think Huffy nailed it. It is tricky. Look, investors get antsy if you've got too much cash in your balance sheet. People are afraid you're going to do something stupid. And I think Jeff, he alluded to that in his earlier remarks, and also, the fourth thing that shipping companies can do. But from our perspective, and I don't think any CFO has ever said, "Yeah, we've got enough cash."
Yeah.
I'm with Jeff, and also this business is brutally cyclical. So, as much as we're all enjoying good or great markets, I suspect every CFO in this room can tell you exactly how long he can last in a zero TCE environment, because that's our job, is to see the glass is half empty. And so, again, it's always striking that balance. And as Jeff just alluded to, sorry, Alhafe, as Alhafe said, you've got to communicate it correctly, because if you're sitting there with a bunch of cash and you're not doing anything with it that investors deem worthwhile, you will get penalized. And I think that that part of investor relations and shareholder communications is absolutely critical. Say, and you just heard it here. Hey, we're probably not going to invest now. Doesn't mean he's not going to, but that should be a positive sign for investors. And I convey the same thing. We're going to be smart, and again, we're going to try to raise capital cyclically and invest counter-cyclically. It's art and science, and it's tricky.
Yeah, I think I would say, Tony, that having Ted and Jeff here, I think these two companies are probably, if you think about the template for how you want to be best positioned going forward, this is it, right? You don't want to have so much excess cash that people are going to question what you're doing, but you want the ability to go ahead and raise capital as you need to, and especially when you see opportunities. And so I think these two companies are probably very good examples of how you do that. I think the other part, which to me, as a CFO, I'm sure what they're thinking about is cash break even. They're thinking about what the rates could look like over the next several years. But I think this liquidity point is something that oftentimes as a shareholder, I think you have to trust the management team to know, is this the right amount of liquidity I have, and what is the best use of that capital? The other thing which helps is, we're in a positive interest rate environment. It was not, several years ago when we were having a zero rate interest environment, having a lot of cash on the balance sheet, investors were not happy. But now we're in a positive interest rate environment. That also helps as part of obviously preventing a negative drag on the cash. So I think this is a pretty unique time. I love the fact that most companies do have a lot of liquidity. I think it's, and that liquidity is in the form of, it could be, like you said, a revolver, it could be actual cash on the balance sheet, or unencumbered assets, which I think is another pretty solid way to think about liquidity.
Okay. Oh, thank you. And our time's winding down, but we'll maybe take a little stab at talking about investor activism. And it seems to be creeping into the shipping industry. The sort of general market in the United States at large, 2024, I think, was a sort of a historically large year of activist campaigns against public issuers. 2025 seems to be following along pretty closely. Don't see so much of it. It seems to not be too common in the shipping industry, but there are signs that it could become more active. What do you all see as the future for activism in this industry, and what are the things that you do if it happens to try to defend your companies against it? Ted, start you.
Okay. I mean, I agree with your assessment, Tony. I think in the grand panoply of investment options for activists, shipping is pretty low on the list, because typically activists like to point out the 27 things that Red Lobster was doing wrong, and Olive Garden was doing wrong, and how they're going to fix everything. And sometimes it works, sometimes it doesn't. We don't make widgets. You can't smash two factories together and take out a bunch of synergies. So if you really look at our cost structures, look, you cut OpEx at your own risk. Be really careful about cutting your crew costs. You don't go to the cheapest brain surgeon. You don't want the cheapest captain operating your multi-$100-million piece of equipment. You look at and I've had this discussion because we were the target of an unsolicited proposal in 2018, and having talked to investors, one of them said, well, why can't you take out costs in, spares and stores? I said, do you know how many engine makers there are, maritime engine makers? There's two. Do you think you can buy better from them? No. Lubricating oils. Do you know what ExxonMobil's world market share is? It's 50%. You're not going to buy better. So maybe there's some G&A takeouts. You also, as an outsider, run the risk of really getting the asset cycle wrong. Obviously, we've seen, activism from within the industry, and I think, that's been touched on. We experienced it. Jeff's experiencing it. Peter's experienced it there in the back row, and others. So I suppose it will continue to come. But again, it goes back to why we're all public. It is an opportunity to play these cycles, and obviously, activists or third-party, industry investors see that as well.
Well, as Dr. Abenmu said before, health warning is kind of an English expression, but Joe, this is on background. Okay, so if I'm going to tease Ted, that's on background. So I was thinking about this subject tonight, and I thought, Ted's a smart guy, a good friend, but as Al Jefe here, I was thinking, I got to keep it simple here, like maybe
Thank you, Al Jefe.
Yeah, went to maybe to Sesame Street. Take a look at some letters for activism. So, okay, we have the big A, activism. Okay, we have a little a, activism. It took me about 15 minutes to get this right, 3 this morning. And we have the M&A. So those are the letters. And Ted, I'm glad you went first because you kind of mentioned that, right? What I mean behind this is big A activism is Elliott, Ackman, Greenlight, Starboard. If we all had an extra zero in our market cap, 10 times, and if there were serious issues to be addressed, we should, as public companies, expect to see activism. We don't. We're not big enough to attract those guys, so whether or not we had issues. But the small A is no joke. There is small A activism. You know what that is? Lots and lots of shareholders. And there are some big long-only companies, like one in Baltimore, I know, that has a department that will do small A activism. What is that? It's not going public. It's writing a letter to the board. As a public company, you should expect, even at our size, to see small A activism. Like, I wish you would do X instead of Y. You're not putting enough capital in that return to shareholders bucket. Please put more or less. They very rarely say that. So small A activism is the thing. But then the question you're asking, Tony, and overlaps, and Ted, you already nailed it. It conflates with, or it's at least a Venn diagram with M&A, because what we do see in shipping is sort of strategic activism, or maybe it's not activism, but stakes and things like that, and you wonder where's it going. So you have to have that all in mind. So that's the landscape. That's the Sesame Street letters. The best thing to do, stop and let Jay take a crack at it, is even if you're doing things great, what Dorian's doing things great, Ted. So
Thank you.
Lois and I and the rest of the team are trying to do things great, but even if you're trading at NAV, just think about, what if you were 10 times bigger and the big guys were coming? Or what if you're having this small A activism? What would they go after? And so first of all, look yourself in the mirror and say, is there something we should be doing different? But if you really think you're doing the right thing, but someone might take a different view, have the answer ready. It's like, I've thought about that. I'm glad you asked that. Maybe we should divest that subsidiary, to pick something that Ted and I don't have, a subsidiary. But we think we want to hold on to it because. So think about that and have your strategy ready. And so the other thing, and you don't necessarily have to have engaged advisors ahead of time before there's a more credible threat, but your CFO should be your internal banker first and doing that job. Lucky for Ted and me, we used to be bankers. But then you should be ready to call two constituencies. One is an investment banker like Jay or Mark Friedman, or I'm only going to mention sponsors of DMB today. Sponsors of Marine Money, sorry, today. So, and don't forget your lawyers. If you are going to have an activist situation, you need to have, and it probably won't be the lawyer dealing with day-to-day, but it'll be one of his or her partners. So talk to Tony, talk to Holland and Knight. What's the others? Reed Smith, Seward and Kissel. I'm only going to mention sponsors, but whoever, and it would behoove you to be thinking that there could be activism, and it could be kind of an investing type activism or M&A type activism, and be ready for it, and hopefully it'll never come.
Well, I'm not sure if I can really top what Jeff said, to be honest. We've obviously seen some level of activism in our space. I think I tend to agree with Jeff that if there was another zero to a lot of these companies, I think you'd see actually much more activism, frankly, in terms of investors looking at opportunities. I know in the past, this has come up really when companies were trading at a significant discount to NAV. That's typically when I think we've seen that come about. Because the argument is made, you can simply liquidate your fleet and then you would be able to return a massive return to your shareholders. But as we all know, it's not as simple as that. It's difficult to sell 40 ships and try to do a massive distribution. But I do think that at a minimum, this the activism, whether it's the big A or the little a that Jeff's referring to, I think it tends to also make sure that there's discipline in the capital markets and discipline among public companies. And so there is some benefit here. It's not, there are certain people who have a certain mindset that they're going to do this for XYZ reasons, right? Sort of you have this sort of green male type effect, right? That is not uncommon. But I do think that most shipping companies, frankly, today, from having thought about this back in 03, 04, when we were covering shipping companies, there's been a lot of maturity and a lot of progression, I think, in terms of the professional management teams, how boards think about this. I suspect there will always be activism with a big A or a little a, but I think, again, important that I think it does. I think most companies are able to address it one way or the other. And so if it makes sense, then it's going to happen. If it doesn't, it's not. So I see Ted's ready
No,
to.
I was just going to say, once again, the issue of cycles comes up. And, one of the issues, and again, perhaps a different view than Collectius, but, there is a decent argument for some of these shareholder defense mechanisms, because someone coming in at the bottom of the cycle and picking off value that really should inure to the benefit of all shareholders over time makes sense. I mean, look, we got pitched a lowball offer at the bottom of the cycle, and even though we spent a lot of money on advisors, the deal was never going to happen, never went anywhere, and we outperformed our putative acquirer over time. And I think we didn't happen to use a poison pill, but on the other hand, if we had sort of allowed someone else to cream off those assets at the bottom of the cycle and taken our free cash flow and not done the things that we did with it, shareholders have been much worse off. And so I do think overlaying the cycle timing with capital allocation decisions and the big A and little a and M&A is, again, all part of it, but it plays a huge role in determining the right course of action for your company, in my view, for sure.
Anything else, guys, on that topic? Because I think that's we're about out of time. Yeah. So well done. You've used the time very wisely. So thank you.
Thank you, Tony. Well done.
Tony, before we go, it's become a tradition that El Jefe hands out a little gift to El Ted here. So he didn't talk about it and label it, but before there was a supplemental dividend, which is what we have, there was, Ted already grabbed the term irregular dividend. So that's what Dorian calls it. So irregular dividend. And last year I told him I felt a little bad about that, so I gave him a bottle of Pepto-Bismol. So I want to give him a little encouragement. Things are going so well at Dorian. They've done such a good job that you don't really need Pepto-Bismol anymore. So just going to go with Tums. So this year, just Tums, okay?
Thank you.
Keep up
El
the
Jefe,
irregular
Alan.
dividend.
Will you autograph it for me later and take a picture with it?
Thanks, guys.
Thank you.
Appreciate it.